builders want to get the biggest bang out of their communities. And so if it's, this X size lot, this X size home is what does it. But if those aren't selling and you got to go smaller and squeeze them in and pack them in, that's
Yep.
what they'll do as well. And so that's an affordability adjustment. It's a unique one, but that's when they're doing.
Alrighty, folks, we are truly lucky to have the CEO, founder of Resi Club, Lance Lambert, on the show each week because we get an insight into what the big boys are doing. Lance, thanks for coming back, man. You're great.
Yeah, thank you for having me. I really appreciate it.
Awesome. Well, the first thing I want to do before we get into all the charts and all the data about effective interest rate lock in down to the state level, which is amazing, I want to kind of step back and say, hey, interest rates have kind of normalized, right? We're kind of at the 7.5 for ORaaT, 8% for investors. We've kind of been here almost all year. Curious, what are the big boys doing? And by the big boys, I mean builders, right? Because, are they building smaller? Are they building bigger? Are they stopping? Then maybe what the big institutions are doing around build for rent. Are they coming back? Are they staying out? What are the big boys doing because rates are so high, Lance?
Yeah, so the big boys, and let's kind of put them into different buckets. So we'll have the big box single family home builders. That's one group.
Okay.
Another group, let's call it capital going to build to rent, which is buying from those same builders. And then another group, let's call it scatter buying.
Okay.
And you know what? Let's just throw a fourth group in there. Let's just throw the iBuyer group in there as
Okay.
well. And
All right.
so we've seen across these four different categories is a very different story. And it makes a lot of sense because if you look at the market, there's been a lot of variation and bifurcation within the market where existing transactions are on a population adjusted level, the lowest in my life right now.
Yeah.
Uh, but then the new home side, they're still selling. And so you have that bifurcation between the market. And so with the single family builders, what they've done, and this really dates back to the second half of 2022 and the mortgage rate shock, while mortgage rates at that time are slightly lower than now, even in 2022 at the second half of the year, it was that shift. It was so
Yeah.
fast going from three all the way close to seven. It destabilized the market briefly. So what builders did is they went and they took the largest ever profit margins that they had and they deployed the right amount of affordability adjustments to meet the market. Every
Yeah.
market's different, every community's different. Some markets, in Northeast, where there's not much new construction and resale is very tight, builders didn't do diddly squat almost in some
Right.
places. But the places that had a lot of inventory and then maybe also had the pandemic migration, which kind of pulled back in some places, they did more adjustments.
Mm.
And the incentive of choice this cycle, and this is one of your calls really, is that this is kind of a repeat of the 80s and the early 80s. And the incentive of choice in the early 80s, buy downs. And that's what it was this time, mortgage rate buy downs. And so that's, been the number one incentive this cycle. Another thing they've done, and this is kind of an odd affordability adjustment and one you can't necessarily do quickly, it takes time, going smaller, right?
Yeah.
Builders want to get the biggest bang out of their communities. And so if it's, this X size lot, this X size home is what does it. But if those aren't selling and you got to go smaller and squeeze them in and pack them in, that's
Yep.
what they'll do as well. And so that's an affordability adjustment. It's a unique one, but that's when they're doing. That's single family builders. The iBuying side of the market, which is going out, making that immediate offer to somebody, and then, trying to offer them fees for whatever you think would take to repair the home. It's essentially like a home flip, kind of like
Mm-hmm.
a weird type of home flip that tries to reduce the transaction cost. And if done at scale, they can make money in theory,
Mm-hmm.
can
In theory. Yeah.
yeah, that's what they tell their investors. And so iBuying, you've seen Zillow in 2021 into 2022, and I just did a deep dive on where and who Zillow sold those homes to. So if you want to take a good follow-up that's in depth to what Zillow did from 2021 into 2022, Google ResiClubAnalytics.com and read that story. It's a great deep dive. But Zillow and Redfin got out of the business. Open Door and OfferPad stayed in. They cut way down on the number of homes they were buying, and still it's only slowly moving up. That's the iBuying side. Now institutional capital. And this is very interesting because the institutional capital, which so the institutional capital is very varied across the segments. And if you want a really big picture that goes outside of single family, an interesting one to look at is Blackstone. Their
Mm,
redemptions are still very high and they're not
yep.
fundraising much.
Yep.
And so that's a proxy for the whole space. And that's dominated by multifamily office, all of the commercial side. Now, within the single family side, they have really pulled back on the number of homes they're buying scatter, right?
Mm,
Going and just buying a home here, a home there. And the reason is that just fewer of these homes cash flow at the moment.
correct.
There's, and they're competing against your audience, right? And that competition, there's competition there. It's especially for properties that cash flow, and not everything checks the boxes that they want. And keep in mind, the institutional side is chasing yields. And
Correct.
so when the Fed is hiking rates and there's these higher bond retail or returns, right? You can go buy treasuries, get 4%, right?
Yep.
5%. And so that becomes competition for institutional capital. And so scatter is down, but they're not necessarily selling a lot of these homes. It's kind of just they're not buying a ton, they're also not
Mm,
selling a lot. Now, with build for rent, that's interesting because build for rent saw a huge boom. And really, it's been something that's been at play for like 10 years, right?
right.
Slow moving up. But then during the pandemic, it's started to move up a lot more. And let me share my screen to show the numbers of the
Hmm.
completions here. And so give me a second. I'm going to share with you if my screen will cooperate.
Mm.
Okay, so here's the number of build for rent completions for single family by year.
Oh,
And these
wow.
numbers can vary a bit, but this is Yardy's numbers. Look at that. It's just taken off. And this is
Almost 100%. Almost. Wow.
yeah, it's about 300% from pre-pandemic levels.
Mm,
And so there's a lag here where a lot of this was financed and capital poured in over here in 2021 or 2020. And so there's a lag. So this should maybe decelerate, is what Ivy Zelman has said, but it might not decelerate as much as people think, because this is still where you're still getting some of the capital moving in, some of the institutions putting capital. Because keep in mind, there's not a lot of great places to put it unless you're saying, I'm going to buy the bottom on offices. I'm going to buy the
right.
bottom on family. If you're ready to make those calls,
Yeah.
and maybe it is, but those also could be long troughs.
Hmm.
Just because,
Correct.
office or multi has hit closer to a bottom doesn't mean it's a bounce off the bottom yet, right? Where it's
Correct.
like take single family housing in 2009, 2010, it had essentially bottomed
Hmm.
closer, still kind of working down. I mean, each market varied, but really the next like 12, 18 months was kind of a bit of a move at the bottom, just kind of sideways, at least the national numbers troughed.
Hmm.
Really, heading into 2012, that bottom just got bought and it happened very quickly.
Yep.
So one of the areas they're still putting capital is build for rent, although, according to my reporting, it decelerated at the end of 2022 and into 2023 in terms of the capital moving in. The completions, very different story.
Yeah.
It very high, and it's going to be high this year. And if you want to look at the pipeline, Phoenix is the juggernaut of build.
Wow. Look at that.
Yeah, they are the juggernaut of build for rent. Then it's Dallas, then it's Atlanta. And Atlanta is the juggernaut of institutional scatter buying. So Atlanta's the biggest for scatter. Phoenix is the biggest for build for rent, single family.
That's amazing. I want to really go back to the builders just for 1 second. Then we can get into effective interest rate and all that other just amazing charts that you put together. I think the builders are important to recognize just for the spin or story that I'll have to deal with from the crash bros, right? One of the things that we've talked about is I expect builders to go smaller. Last year was historically the largest. They fell 3%. I think this year it could go down by 5% because they have to meet the market, right? When they were adjusting prices with record margins, those units were already built and planned. They had to do rate buy downs to move people in. The projects
Yeah.
that they're moving into now were just planned for a higher rate environment. And if the buyers of the future are more single individuals, single guy, single female, not parents with kids, it makes sense, right? I like what I think it was Lennar did in Texas, 661 square feet. I think they did it in Sacramento at 995. I think I saw a report that they're doing 1,300 in Phoenix. Smaller is good. And where I want to go with this, there you go. Crash Bros. Stop giving me a chart about new home prices crashing. You guys are clowns and idiots. They're smaller. They're, that's why the prices are down. This is so frustrating to me. All these graphs I get about new home charts crashing and falling off. I'm like, guys, it's going to get worse. And you still won't understand. And price per square foot will go up. And it's irritating that they could take a graph and not really understand what it's saying. So that's just a personal frustration. And I think it's going to get worse. I think new home prices will go down because the size will go down. So
Well,
that's a
so
little bit of rant.
the problem for the group who is saying that new home prices have crashed 20% is that they then also say, well, buy downs is another 10%, right? So if they're down 30%, how is DR Horton's gross margin still above pre-pandemic levels? I mean, the math
Yeah,
doesn't make sense.
the math
So
doesn't make sense.
some of the
Yeah.
builders have cut prices. And, when I talk to Art Homes for Rent in the Southeast where they're buying homes from builders, they're below the 2022 peak. So the new construction prices have softened much more than existing prices because
Mhm.
existing prices are actually above 2022.
They are.
Uh, but new home, it varies. But in terms of like these huge numbers for national 20, no, it's not. It's not down that much because there is another chunk that is mortgage rate buy downs, right?
Of
It is
course.
the
Of course.
incentives. So it just doesn't make sense, and you can't recreate it with their balance sheets, at least not
Yeah.
for the big builders that we have publicly traded data. So this is DR Horton's gross margin. You can see that during the pandemic housing boom, they had complete pricing power
Hmm.
and it got off the charts
Yep.
despite paying 1,700 per square feet of lumber. Uh,
Exactly.
or I forget how lumber's priced. 1,000 board square feet is, or
Yeah.
1,000
Board
boards.
feet. Board feet, they
Yeah,
call it.
board feet. That's what it is.
Yeah.
And it came down during, once the rates
Hmm.
shot up, they had to do, full percentage point buy down is what
Yep.
DR like to do. And then since then it's, stabilized in a place that's still above, this red line, which is their historical average,
Yeah.
and far above, what you saw during the housing crash.
Very cool. Very cool. Well, let's dig in instead.
I do want
Oh, go
to
ahead.
give you two quotes real fast on the
Sure.
smaller homes before we go. And
Nice.
this is a home in north of Dallas, 43 miles north of Dallas. They're 1,300 square feet. They're going to be priced, it looks like 250, 299.
Mhm.
They're kind of like a detached townhome look.
Yep.
If you look at them, fairly small. They're still bigger than the Levitt homes back in the
Hmm.
40s. Those
Yep.
were 800 to 1,200 square feet. And so I wanted to give people two quotes if I can find them. Here's DR Horton CFO Bill Wheat on their earnings call 2 weeks ago. We have reduced prices and sizes of our homes where necessary.
Yep.
And then if you to Lennar, Stuart Miller, the general theme remains primarily focused around very strong demand for housing, limited by the chronic short housing shortage that is particularly problematic for working class families and their ability to find affordable or attainable supply. Demand for that product
Hmm.
remains robust if it can be built at an attainable price point, smaller
Yep.
homes.
Yeah.
Yeah.
It's coming. And again, I think it is good news. I think the market is thirsty for it. I think they will sell quickly. But again, I know that the clowns will we keep quoting that new home prices are crashing. And that's just a personal irritant because I almost get daily communications with the new home price chart. Hey, Zuber, you're a moron. You're an idiot. Look at new home prices are down 20%. I'm like, just stop.
Well, are they buying them? Are they going out and getting the deals? I mean,
No, no, no,
you
no.
know, or new construction, can they
No,
find?
they're often broke people in mom's basement, so they don't have any money. instead of dealing with my little pet peeve, why don't we talk about the great data that Resi Club Analytics is putting together about effective interest rate by state and some other data you've put together? Because I don't think people have really understand the power that you're giving them to understand their buy box and their area. So bring it up.
Yes. So let me share this. Got more data for you. So this is a talking point of yours is the effective mortgage rate. This is
Correct.
all the mortgages in the country, and then you find out the average mortgage rate of all of them.
Mhm.
And here's the effective by state. And what you see is that this map really makes it clear what this lock-in effect is, this reduced probability of sale, these high switching costs, is
Yeah.
that pretty much everywhere it's around like 3.9, 4%. And the market rate today, I think I saw it earlier, I think it was like 7.42 today.
Yep. Correct.
So
Mhm.
you got about a 3.4 percentage point difference
Yeah.
between what the typical homeowner has and what is the market mortgage rate today.
Yeah.
So a huge gap still. And if you want to understand what impact that's having on the market, and all of these charts, I publish them on ResiClubAnalytics.com. You can put
Mhm.
in your email there and get them emailed. I do 5 free stories a week
Yep.
around. Plus, I have my premium product where I put out more charts.
Mhm.
This is one that went out to my premium readers, Resi Club Pro. This is the number of lost sales for every state in the
Wow.
country because of the lock-in effect. So nationally, according to researchers at the Federal Housing Finance Agency, FHFA,
Mhm.
the US has lost 1.3 million home sales on the
Hmm.
existing market to the lock-in effect. So that's 1.3 million homeowners who were like, I'm not selling, I'm just going to stay. That otherwise would have moved had
Yeah.
mortgages not went up so fast, so quickly into where it is today.
Let me
And
ask you a question about that. Like, let me just make sure I understand because I think it's even more important than that. I think what you're telling us is, I think you said 1.3 million people didn't move. Could I correlate that to actually 2.6 million transactions? Because most sellers are
uh,
also
oh,
buyers?
so it's 1.3 million home sales lost.
Right. So yeah, home sales, that's meaning I'm not selling because I have a cheap mortgage, but typically I'm also a buyer. Now it's not quite one to one, but could
Yeah,
I
so
extrapolate
I
that to be
think you
even
could
bigger?
say 1.3 million buyers lost and 1.3 million sellers lost.
Okay, there you go. Yeah. Okay.
But yeah, it wouldn't be 2.6 million lost. Um, Presumably those homes that maybe they would have bought, one of the other buyers got, if that makes sense.
Okay, it does. Yeah. No, I understand. I was just popped in my head, so I thought I'd
Another thing
ask.
is some of that group, some of the homes they would have bought are a part of these 1.3 million as
Oh,
well.
that's true. Yeah, that's a good point. Yeah.
So 1.3 million uh, existing home sales lost.
Wow.
And essentially that's taking out 1.3 million buyers,
Hmm.
1.3 million sellers, just lopped off.
Makes
Uh,
perfect sense.
and according to FHFA, while they believe this lock-in effect could ease and could ease more if rates came down a percentage point, or then even a little more if they came down 2 full percentage points, they still believe that there will be a lock-in effect through 2033 at least.
Oh, that's the first time I've heard that. And I agree. I think this lock-in is going to really distort what's often called turnover, right? The average turnover is, I think it was 8 years last time I checked it. We're going to see that thing explode to 12, 13 years. People are just going to stay put.
Yeah, and yeah, it's these switching costs are high.
Yeah.
Now you do have one unique thing about this cycle
Hmm.
is that there are so many freaking people who do not have a mortgage at all.
Yeah.
So
40%. Yep.
yeah, so 10 years ago the number was 33%. Now
Oh, I
it's
didn't know that.
39%. Yeah, I did a story on it for Resi Club 2 weeks ago. I'll send it to you.
Nice. Thank
If
you.
we want, actually, I could pull this chart up if we want to see the historic on it.
Why not?
Um, so here we go. Mortgage-free homeowners. So this group is not
Wow.
necessarily locked in. Now they might be locked in because, the price they want to go to, maybe
Hmm.
there isn't, there's other factors why they might not sell. And they are older, of course. and older Americans are less likely to move their primary
That is
residence.
a pretty steady upward. I mean, that is up and to the right. That slope's pretty consistent.
Yeah, the big reason, baby boomers,
Of
because they're such
course.
a
Yeah.
big piece of the pie, and older
Mm,
Americans already are more likely to not have a mortgage.
that makes sense.
So because you take, so there's such a big group, and as you move them into their older years, it
Mm,
just pulls the data lines. So it doesn't necessarily mean that people are going more mortgage free
yeah.
necessarily.
They're not buying for cash. They're just paying off.
Although there is probably some of the Dave Ramsey effect
I'm
where
sure.
there's like pay down your mortgage, right? All of that. But I don't know if that Dave Ramsey logic financially will be as sticky the next 10 years. And here's what I mean. I have a 2.6% mortgage rate. It doesn't make a lot of financial sense for me to pay that off sooner, right?
No, you make
And
5% interest on your money. Why the heck would you pay it off?
And the net effective mortgage rate today is like 3.94 in most of the country.
Mhm.
Why are they, is that the best use of their capital to pay down their mortgage sooner? So
Yeah.
I don't know if that financial logic is going to be as sticky. Maybe it is more so with the four, five, some of them, but I don't know. And especially now that you have about, of the mortgages out there, it's around 35% or under like 3.2%. So it's like, I don't really know for that group if they're going to.
Yeah.
Um, I think
Yeah.
that's kind of changed a bit. I think that Dave Ramsey logic is going
Yeah.
to be a little less sticky given the environment.
It made a lot more sense at 18% than 2.
Now, now, who will probably follow it are 2023 buyers,
Yes.
2024, the 7, 6, even if they refi down to 5.5, 6%, they still might, go that route for
Hmm.
them personally.
Yeah.
It just some bifurcation in terms of that logic.
Yeah. Very, very cool. Well, Resi Club Analytics is amazing. Do they just go to Resi Club Analytics, give an email, and they get all this great stuff?
Yeah, let me show if I remember. Yeah, there we go. I was blanking on my own website for a second.
Yeah.
So you go to resiclubanalytics.com. You just go right here, type in your email, and you will get signed up for the free newsletter. And then you can also go through, read the archive. A lot of these charts that I talked about, I think I've written a few hundred stories now. I don't know. We
Wow.
got quite a bit of pieces that we've turned out. And if you're looking for a certain type of housing data or something on your market or something, feel free to give me an email. There's good, or send me an email. You can reach me at lance@resiclubanalytics.com. I'd be more than happy to, if I have the data, maybe help you out.
Yeah,
I
you're amazing.
produced a lot of charts.
There you go. There you go. And again, folks, Resi Club Analytics, lots of free stuff, but the premium gives you the in-depth details. If you have a buy box in the area and you are truly shopping, you might want to give that a look. Lance, you're amazing. Thanks for the time.
Thank you.
Mhm.